Good evening, everyone. Time for another silver update. This is the monthly euro-dollar chart, and that's over at More Research. The reason I brought this up, I wanted to show you some things about the interest rate here and in Japan, etc. But before I do that, I want to show you how to read this chart. This is a total of 100. You subtract the price from 100 to get the interest rate. So effectively, a price of 100 is a zero interest rate. And you can see that we're kind of not changing at all here. We're kind of stuck at 0.5%. We've been that way for about 3 years now. So the financial crisis struck in 2008. You can see them dramatically lowering interest rates. They actually started to lower rates in late 2007, and they were all the way up at 6%, believe it or not. Now you can figure that out by subtracting. It's 94, that's an interest rate of 6%. This is a euro dollar. It's the functional equivalent of the treasury bill. So you can see on this chart that back in 1982 the interest rate was actually 17%. Short-term interest rate was 17%. And for a significant part of the 80s, it was near 10%. All the way to 1984, and then it went up to 6%, or down to 6%, and then came back up to 10%. And then you can see that we've drifted lower and lower and lower until we're kind of stuck at 0.5% interest rate. Now, if we go over and look at Japan, you can see that the Japanese stock market, I believe it crashed in 1990, and you can see the response. They lowered interest rates, and then they kind of held off lowering, and then they pretty much just went down to zero. So in about late 90s, they got their interest rates down to zero, and they pretty much just stayed that way ever since. So is that where we're heading? And I brought up a picture of a EKG flatline to show in comparison. So is that going to be the state of the economy? Kind of like a heart that just stops beating? Are we going to emulate the Japanese and just flatline? If we go to the United States and choose interest rates, you can see that we're just kind of starting this Japanese experience here. Go back to 1971. So you can see, beginning right there, flatline. It's almost like the economy has died, just like this EKG. So that's pretty scary when you think about it, that the economy has basically been dead since 2008. But that seems to be what this chart indicates. Now, I wanted to read a little bit of FOFOA's interview on the India site because I think he brings out some important points. Before I do that, I wanted to go over to the Got Gold report and play a little bit of that because he brings out some interesting things about he has some great charts there. One of my viewers, thanks for sending it, sent me the link, and he's got some great charts here. And so let's listen to a little bit of this.
And here's the silver LC&S graph. And in summary, we have a bull market record low net short position for the traders the CFTC classes as commercial. That's the combined commercial traders. Not since the day before 9/11, 11 years ago, have we seen such a low combined commercial net short position. We know that in the past, extreme lows for the LC&S virtually always corresponded with not just lows for silver, but important turning lows. And a turning low is simply an important low, not merely an interim low. We know that as the LC&S rises, it suggests that the big hedgers are becoming more convinced that silver is set to fall in price, and vice versa. Or maybe a better way to say it is that as the blue line rises in response to higher silver prices, they become more motivated to hedge their metal and positions against lower prices. And as it falls, they are positioning less and less for lower prices. Therefore, the very low bull market record LCNS today suggests that the largest, best funded, and presumably the best informed industry commercial traders, the big hedgers, are the least positioned for lower silver prices they have been in 11 years, the lowest since silver was $4.18 an ounce. Finally, we know that a big part of the low LCNS is because the mercenary commercial traders called swap dealers are the most net long in the history of the DCOT, and at the very same time the usually net long funds hold record high short positions, both of which represent pent-up buying horsepower. It's waiting for a signal, a sign, a convincing bust out of the relentless downtrend silver has been in for 4 consecutive months.
So that's the report. I encourage you to listen to it. He's got a lot of interesting charts that not just this silver versus LCNS, and a lot of these are indicating that we're at some kind of turning point as far as the commitment of traders numbers and other numbers. Now, I don't put a lot of stock in that kind of stuff because I don't know the reliability of those numbers, but he does a really good job if you're interested in that sort of thing. And of course, I think that he is actually into the futures. Now, I've repeatedly warned people that I don't think the futures are safe anymore, just because of what happened with MF Global and because it's a paper promise. So I guess it's great for people who love to trade and love volatility, and that's their thing. I don't see anything wrong with that if that's what you want to do. But for me, stacking physical silver is a whole different thing. I'm interested in silver because I follow it to see when to stack it, follow the charts and everything else. But that's all in relation to stacking. I probably wouldn't be any good as a trader even if I tried. But this is very interesting stuff that you can check out, and they've got a lot of charts coming from those commitment and trader figures. Now, I wanted to read the latest FOFOA. He's actually being interviewed on an Indian newspaper, kind of interesting, and I'll put the link there. It's also on this on FOFOA's blog, but it's an English language newspaper in India decided to do an interview with the mysterious FOFOA. So I'm going to cut down to the most important point and part of it and read some of the interview. So, what are you predicting? They ask him. But don't get me wrong, it's not a short squeeze that I'm predicting. In a short squeeze, the paper price runs up until it draws out enough real supply to cover all of the paper. But this paper will not be covered by physical gold in the end. It will be cash settled. And it will be cash settled at a much lower price than the price of a real ounce of gold. Like a check written by an overstretched counterparty. It is a tough job to make my case for the future, and he uses this term, dollar price of gold. So when he says dollar price of gold, he's talking about paper gold as opposed to physical gold. Make my case for the future dollar price of gold in just a few paragraphs. The dollar price of gold will fall, and then some short time later we will find that the market has changed out of necessity into a physical only market at a much higher price. If you were holding paper, you will be sad. If you were holding the real thing, you'll be very happy. Why is the gold price so flat these days? Today's surprisingly stabilized dollar price of gold tells me that someone is throwing money into the fire to delay the inevitable. Where do I see the dollar price of gold going over the next couple of years? Maybe to $500 or less, but you won't be able to get any physical at that price. I think that today's price of $1,575 is still a fantastic bargain for physical gold. Question. Franklin Roosevelt had confiscated all the gold that the Americans had in 1933. Do you see something similar happening in the days to come? No, not at all. The purpose of the confiscation was to stop the bank run epidemic at that time. There is no need to do it again. The dollar is no longer defined as a fixed weight of gold, so the reason for the last confiscation and subsequent devaluation no longer exists. Gold that's still in the ground is a different story, however. Gold mines will likely be considered strategically important national assets after the revaluation and will therefore fall under tight government control. Question. The irony of the entire situation is that a currency like the dollar, which is being printed big time, has become the safe haven. How safe do you think is the safe haven? Answer. Indeed, everyone seems to be piling into the dollar, especially on the short end of the curve, helping drive interest rates ridiculously low. The dollar is as safe as a bomb shelter that's rigged to blow up once everyone is safely inside. You can go check it out if you want to. Sure, from the outside it might look like a shelter, but you don't want to be in there when it blows up. You've got to realize that it is both economically and politically undesirable for any currency to appreciate against its peer currencies due to use as a safe haven. Remember the Swiss franc? As soon as it started rising due to safe haven use, they started printing it back down. The dollar is no different, except it's got a whole world full of paper obligations denominated in it. So when it blows, the fireworks will be something to behold. Question. What will change the confidence that people have in the dollar? Will there be some catastrophic event? That's the $55,000 question. It is impossible to predict the exact pin that will pop the bubble in a world full of pins. But I have an idea that it will be one of two things. I think the two most likely proximate triggers to a catastrophic loss of confidence are a major failure in the London gold market or the U.S. government's response to an unexpected budget crisis due to consumer price inflation. Most people who expect a catastrophic loss of confidence in the dollar seem to think it will begin in the financial markets, like a stock market crash or a treasury auction failure or something like that. But I think it is more likely to come from where, I like to say, the rubber meets the road. And here I'm talking about what connects the monetary world to the physical world, prices. I think these worlds are connected in two ways. The first is the general price level of the goods and services, and the second is the price of gold. If one of these two connections is broken by a failure to deliver the real world items at the financial system prices, then we suddenly have a real problem with the monetary side. So I think it will be a relatively quick and catastrophic event, but maybe not as dramatic as a major stock market crash. It will be confusing to most of the pundits as to what it really means, so it will take a little while for reality to sink in. Question. The Romans debased the denarius by almost 100% over a period of 500 years. The dollar, on the other hand, has lost more than 95% of its purchasing power since the Federal Reserve of the United States was established in 1913, nearly 100 years back. Do you think the Federal Reserve has been responsible for the dollar losing almost all of its purchasing power in 100 years? Yes, inflation was a lot slower in Roman times because it entailed the physical melting and reissuing of coins of a certain face value with less metal content than previous issues. This was a physical process, so it occurred on a much longer time scale. The dollar, on the other hand, has lost nearly 97% of its purchasing power in roughly 100 years. Do I think that the Federal Reserve is responsible for this? Well, given that the lending/borrowing dynamic causes expansion of the money supply, I think the government and the people of the world would share in the responsibility. But just because the dollar has lost 97% of its purchasing power doesn't mean that any individual lost that much. How many people do you think are still holding on to dollars today that they earned 100 years ago? How long would you hold dollars today? As long as the prices of things you want to buy don't change during the time you are holding the currency, what have you lost? So imagine that you simply use currency for earning, borrowing, and spending, but not for saving. Will it matter how much it falls over 100 years? Your earning and spending will happen within a month or so, and prices won't change much in a month. Also, your borrowing will be made easier on you as your currency depreciates, and your gold savings will rise. So with the proper use of money, there's no need for alarm if the currency is slowly falling at, say, 2 to 3% per year. Do you see America repaying all the debt that they have taken from the rest of the world, or will they just inflate it away by printing more and more dollars? The debts that exist today can never be repaid in real terms, and as I mentioned before, they are all denominated in symbolic words like dollars, euro, yen, yuan, and rupees. The debt of the U.S. Treasury, most of all, will of course be inflated away. So that's the FOFOA. Wow, there's actually 403 comments on that. That's his interview on the DNA Money Report, which is, as I said, a publication out of India. So very interesting, some interesting points there. He talks about the aspect of money that is a store of value, and he's not really concerned about the dollar losing 97% of its value since the founding of the Federal Reserve, because nobody should be using the dollar as a store of value. Now, of course, your wages, even though prices are going up, doesn't necessarily mean that your wages are going up. So that's going to be a problem. But he is correct in that if you're using the dollar as a store of value, you're making a serious mistake. Of course, what I recommend, and a lot of others recommend, is that what you should be storing your savings in is physical silver. That's a true store of value. It's no one else's liability, and also is extremely undervalued, and is due to go up quite a bit from here. At least a lot of people think that. So let's pull out the long-term silver chart and off of more research, and take a look at the long view. So we can see that silver has formed a similar formation to the one that it formed in the late 70s. It has corrected back. You can see it's corrected back more than 50% from this chart. But, well, actually, no, at just about 50%, because it ran from $5 to $50. So just about 50%. But unless we are going to experience this type of move, and if you remember when I showed you on the euro dollar chart, at this time frame, the short-term interest rates were 17% in 1982. So are they willing to ratchet up interest rates to 17% to bring the silver price down, or to bring the gold price down, or to bring the economy down? That's basically what it would do. I don't think they're willing to do that. So from this chart, if it is not one of these moves, then it's going to have to be one of these types of moves. And I think we're very close, especially when we look at the Got Gold report and you look at the commitment of traders. We may be very close to the type of rally that we've seen in the past. And those rallies, you can see on his charts, they can become very violent and move up very quickly. So time is of the essence to keep stacking, and we'll talk to you next time.